This episode is sponsored by SmartVestor. Connect with an investing pro for free at RamseySolutions.com/invest. You're listening to Ramsey Everyday Millionaires, where we talk investing, retirement, building wealth, and outrageous generosity.
Susan's with us in New Orleans. Hi, Susan. How are you?
Hi, I'm well. Thank you so much.
Good. How can I help?
Well, I'm learning how to navigate my finances alone for the first time in 30 years. And I hope that I'm not confused, but I have a $750,000 variable life insurance policy that I've had for about 20 years. It's something I carried after after leaving one of my employers. And I've recently looked into this to try to understand more, and it has about a $1,500 cash value. After years of paying hundreds of dollars a month in life insurance, and it's premium.
Wow. You said
Well,
recently alone. Good. Are you widowed or divorced?
I'm divorced.
Okay. After how many years of marriage? 30?
Yes, sir.
Wow. I'm sorry. That's a heartbreak. And who's this policy with? Which company?
It's Metropolitan.
Yeah. Okay. All right. Typically, what a variable universal life policy applies to is, obviously, it's a type of cash value policy that you pay extra for beyond what you would pay for term, and the extra goes into an investment. And with variable, it generally is mutual funds that you select the mutual funds, or they select them for you with a rubber stamp situation, and you don't even realize you did it. But basically, it's going into that. Then they take all of their fees out, and so you don't get anywhere near the return that you would have gotten. Nationally, the typical variable is about a 4.7% rate of return on an investment that, not counting fees, should be yielding north of 10. So it's an absolutely bad product, but it's hard to fathom that you paid 20 years and only got $1,500 out of it. That's hard to believe.
That's what it shows me, and it's one of those things where I never really...
Have you called them?
No, that's on my list, but I just wanted to really start to understand more about the policy.
Yeah.
So that I had some information.
It's possible that it is a dumbed-down product that was sold as an HR benefit through a benefits company. And by dumbed down, I mean that they didn't charge you enough over what the actual life insurance was for there to be any going into savings hardly.
Okay.
And so I don't know what you've been paying, but or the policy is $750,000, so it's less than $1 million policy. How old are you today?
I'll be 65 in September.
So you bought it when you were 45, and was it guaranteed issue? Meaning, did they make you to go through a medical?
No, it was one of the benefits that I signed up for when I went with that employer.
Right, but they did not have any medical check. Like if you bought $1 million policy, they're going to check medical usually.
Yeah, no, sir, not any of that.
So guaranteed issue is what that's called, and that's a standard in the benefits world. There's nothing wrong with it, but it's a more expensive type of insurance because they're taking more risk because they're not checking people's medicals. That makes sense?
Okay.
And so you're probably paying a lot more of what you were paying. A lot more of it was going towards insurance versus if you had just bought a regular variable universal from them out in the open market and done a medical. So that's part of where you got ripped off probably. And my other guess is that if I knew the premium amount, it probably wasn't enough to have a lot spilling over into cash value. So it's very possible that what you've learned is true. I'm sad to say. Now, the good news is you can stop doing it. You have a hole in your pocket. You don't keep putting money in it. And then we need to ascertain even if you need life insurance at 66 years old or 65 years old.
Right.
So do you have assets?
I do. I own I don't have any debt except for the mortgage on my house.
Mm-hmm. And
then I have I have two fixed retirements, one from my military service, one from my current employer.
Is there any children that came on late in the game that are still dependent upon you?
No, sir.
Okay. So financially speaking, not emotionally or relationally, but financially speaking, no one's counting on you. So if you didn't leave life insurance from a dependent standpoint, the family's not going to be damaged.
No, I would like to have life insurance that would cover any mortgage amount I would have so my children wouldn't assume that.
They don't assume it. The house will cover it.
Okay.
Yeah. You don't need to leave your house mortgage-free by paying this policy. And buying another policy at your age or my age is not usually a good mathematical plan.
Right.
So how much money do you have in your nest egg?
I have about 9 months worth of expenses. So
You
I
have
could
a
live for 9
retirement
months.
nest egg of any kind?
The 401k I had during my marriage, and I did not leave my marriage with that.
Okay, so he got that. And so you don't have a, quote, pile of money in a retirement account somewhere?
No, I don't.
Okay. You're living off the pensions, and that leaves you just fine?
Correct, yes.
Yeah, okay.
Are you still working, Susan?
I am.
Okay.
What do you make?
Yeah, what do you make?
And I'd like to keep working. I love what I do, so
Good.
I'm not in a rush to retire.
Good. What do you make?
About $100,000 a year is my salary.
Good. Good for you. Okay. And what's the balance on the mortgage?
218.
And what is the house worth?
325.
Okay.
325 to 350, I guess.
Okay. So if you were to pass away tomorrow without life insurance, the kids would sell the house. There'd be $100,000 on the table. They would pay for a funeral, and the smoke would clear, and they would all get a little bit. Correct?
Correct. Yes, sir.
Okay. I'm not buying this life insurance policy another day. Then.
I agree with you. That was my first reaction. But then I'm thinking, and the premiums have gone up every year.
Yeah, they do.
As I age.
Yeah.
But this is hundreds of dollars a month for years that I have been paying.
But
and
that doesn't mean you want to keep doing it.
No, but I just made the bad decision with that investment.
Yeah. I think you probably did. But it's, as they say, water under the bridge.
But I would call them too, Susan.
I want to call them and make sure I
ideal,
understand it.
they left off a 0 or something. I don't know. Maybe there is more in there, and it was a typo.
It's possible, but I think with it being a guaranteed issue, and I think with it being a benefit, they lowered the price on it so low that they didn't put enough in there to cover the insurance.
Yeah, but it just was so expensive just for the insurance side. I know because she didn't do medical, but
that's because variable life insurance is a complete ripoff. It's the payday lender of the middle class, but if you invest $100 a month from age 25 to age 65 in a decent growth stock mutual fund, it will be $1,176,000. So you should be taught this in the 6th grade so that you start investing in your 20s, because it doesn't take a lot to become wealthy. Our last caller put hundreds of dollars a month for 20 years into a rip-off life insurance policy. My point is, if she had put that money in a fruit jar and just stacked it in the cellar, she would have a whole lot more than she has in that policy, like tens of thousands of dollars. I mean, she's putting in, let's say
hundreds a month.
Let's say $200 a month. Okay, that's $2,400 a year, and so in 10 years, that's $25,000. In 20 years, that's $50,000 would be stacked in her cellar. If they have $1,500 as her cash value, what that tells you is they screwed her. That's what that tells you. Okay. She not only didn't get a rate of return, she got a negative rate of return. They stole from her savings to pay for high-priced life insurance. That's exactly what that product does, by the way. If, however, she had not put it in the cellar and it wasn't $50,000, and she had instead put it in her 401k, or which she lost in her divorce, but or negotiated away in the divorce, or whatever happened there, or she put it in just mutual funds, hundreds of dollars a month for 20 years, it would have been several $million. And so that's how bad these cash value life insurance products are. It's not just a little bit wrong, it's millions of dollars wrong over 20 years. Millions with an S. Lots of millions. That's just bizarre to think about. And if you wonder how as a buddy of mine used to say all the time, there's two main towers in the skylines, banks and life insurance companies. And in the old days, particularly, that was true. In the skyline of the average city, when you drive in, there's two sets of towers, banks and life insurance companies. And who you think built those? Well, it wasn't built by Santa Claus. You built it with your money getting screwed by those people in both cases.
Yeah, so instead of $200 going to an insurance policy, she could have paid $30, $40 for a term life. And then you would have had $150 to invest, right? Like that's the problem is the difference in what you pay.
For $1 million a term, you could buy that easy at 45 years old. Yeah. And so you buy inexpensive term insurance for the time that you actually do need life insurance.
Yeah.
Half the time she kept this policy, she didn't need it. She kept it because it was an investment.
Yeah.
In air quotes, an investment.
Thanks for listening to Ramsey Everyday Millionaires. Need help with your investments? Connect with a SmartVestor Pro at RamseySolutions.com/invest or click the link in the show notes. Ramsey Solutions is a paid non-client promoter of participating pros. Learn more at RamseySolutions.com/SmartVestor.